Hey traders, Park here with another video on the where the market is. Markets are rotating, where money's actually flowing, and what to do now. You can see right here we have all the information about the percent change and where some of these rotations happening. We're not in a clean bull market. We're not in a confirmed bear market either. We're in a transition phase. You can see where it's marked by this indicator right here. And money is rotating aggressively. If you don't understand where capital is moving right now, you'll trade the wrong things at the wrong time. Let's break down exactly what's happening, why it's happening, and what to do about it. You can see from our screen, oil is still pushing up. We're still waiting for that deal in the Middle East. Where money is flowing, year-to-date leadership is still energy dominant. This is where we have energy right here. Materials are strong as well. This is right here. And you can see from my labels as well, materials is number 2. It's up 14.11% for the year. Technology is trying to re-enter the trade. You can see right here, still below the average. This yellow line represents the average of the 11 sectors, but it's greater than the S&P 500. So that's another great thing right there. Consumer discretionary and healthcare are lagging. You can see from here, and you can also see from down here as well. Credit markets are not confirming the equity move, and you can see right here credit is still down right here. That last point matters more than most people realize. This is not a broad liquidity expansion. This is selective inflation driven rotation. What the cross asset market is saying, oil is aggressively up this year. Copper is firm. You can see from my label up here. Gold is still positive. At the same time, dollar is holding up. Long bonds are weak. High yield credit is not expanding. That combination tells us something important. The market is pricing inflation pressure, but not pricing easy financial conditions. That's fragile. That's a fragile setup. And you can see right here where we're kind of sort of pricing in this stagflation over here. That's when commodities are strong, but credit isn't confirming the system is under tension. Why this is happening? Several micro drivers are behind this. Persistent inflation expectations, ongoing geopolitical energy risk, supply constraints in commodities, central banks still cautious on easing, fiscal spending still flowing into industrial sectors. And you can see over here, all these defensive sectors are all up right there. That money isn't chasing speculative growth. Even though we have the RTY, which is the small caps, pushing up, and it's way above the S&P, the QQQ, and the NASDAQ. Anyway, the money isn't chasing speculative growth. It's positioning around real asset industrial strength. This is more inflation. This is more reflation rotation than momentum mania. What this means structurally right now, the regime probability looks roughly like this. Reflation, high probability. Bull, moderate probability. Stagflation, not off the table. Bear, still persistent but not dominant. That tells us something critical. The market can rally, but it's not structurally clean. It requires confirmation. And you're not really getting these confirmations from some of these different areas in the market that tell you, hey, we're in a bull market, even though we made a new all-time high on the S&P 500. So, just do that. There's our chart for the S&P 500 here. Made an all-time new time high right here. The biggest risk right now is energy and materials rolling over. While credit weakens further and the dollar strengthens, that combination will shift us towards stagflation. If that happens, growth sectors, let me make this back small again. Let's do that. Growth sectors get pressure, discretionary underperforms, indices stall, volatility expands. You can see from right here, this represents the VIX. It's purple. It's this what is it, a fuchsia color, pastel purple right now. So if it was bright purple, it represents more. So the VIX was going higher, but it's not. It's actually coming down. You protect yourself by watching the credit and the dollar, not headlines. You can see right here, credit is down, but the dollar is going up. Protection right now is about positioning discipline. Size matters. Trade leaders only. Avoid laggers unless shorting. Don't overexpose to one thing. Respect volatility around key levels. If credit spreads widen and VIX expands, you reduce exposure immediately. This is not a buy and ignore environment. This is a monitor and adjust environment. How to take advantage of this environment. This environment rewards rotation. This environment rewards rotation traders. And you can see the rotation right now, we're leading towards the XLK and XLB. XLB is the material sector. Let's go XLB. XLB is the material sector. And you can see we're actually up if I push it to this 3-year gap right here. I actually bought some on a whim. Just but anyway, really looking at the materials and the XLK. The XLK is actually breaking out. So XLK, just gonna go. You can see it's breaking out right now, but it hasn't made a 52-week high or all-time high. I'll say that. All-time high back here is 153. So what's really working here is buying pullbacks in energy and materials. Relative strength trades in small caps. Let's go back to my graph. Selective tech leadership, not broad tech spread trades. RTY versus futures. Sector rotation pairs. You don't chase vertical moves. You buy control pullbacks inside leadership, and you exit quickly when leadership stalls. One of the ways I've been playing it is buying the leadership in the LITE is lithium. These are the not fiber optic, but the ocular names for the new technology for the lasers and stuff that they need. So this is the leadership in this area. So I've been playing AOI off of that one. I think I'm in AOI somewhere around $40-something and just riding it up. I had that mark down there in case it did pull back. But anyway, right now these catalysts matters most. Inflation data releases, Fed commentary on the rate trajectory, energy-related geopolitical developments, Treasury issuance, and bonds auctions, credit market stress signals, major earnings from financial and industrials. If financials begin leading decisively, that's a green light for broader bull expansion. If credit cracks, risk compresses fast. What to expect next? Here's the likely path, at least in my opinion. Short-term continued rotation, medium-term resolution. One of two things happen. Credit improves, dollar softens, and clean bull expansion. Dollar strengthens, credit weakens, and volatility expansion. We are near inflection point. Expect sharp rotational moves. Expect false breakouts. Expect faster reversals. This is not a passive tape. Closing. Grounded. This isn't about predicting. It's about recognizing structure. Money is flowing into real assets and cyclicals. Liquidity is not fully confirming. The system is balanced on tension. Trade the leaders. Respect the divergence. Protect capital first, because in transitional resonance, survival is the edge. And you can see from the indicator, everything's anchored to the first day of this year. It's been about 71 days since our 70 days of trading days for the year. But right now, you can see it's still a lot of red on the board. Technology is trying to break out, but IGV, which is the software sector, is still being crushed on fears of the AI taking over and programming a lot of these different things. You can see where gold is still green, copper is still going up. That's going to be something that's needed overall. The 20-year bond, the TLT, is still down, but oil is up. But all these defensive sectors are still green, but a lot of these bullish sectors are still red. So right now it's just it's a wait and see, especially with 4 days left on this 10-day ceasefire with Iran. So it really just depends on that, and depends on really opening up the Strait of Hormuz and allowing a lot of stuff come back through. XLE is still up. It did pull back. It pulled back to its previous week or previous month's low right here. That's what this dark green is. It's got to be its previous month's low right there. And it was actually up today. You can see where XLB, I think we already looked at XLB, but XLB, it pulled back from here and now it's pushing above. Material is going to be needed, and XLI, or all this stuff is going to be needed for the build out of those data centers and anything that's going to be dealing with AI. You can see right now it's an inside month and it's a Holy Grail month. So that means that we had an engulfing, previous month was an engulfing month, and now we're in a inside month, and it just says a Holy Grail. So it's just a volatility metric. But you can look up Holy Grail and inside month, and you get a better idea of what's going on with that. XLY, you can see right here it's trying to recover as well, but I think one of the best ones is still XLP. It's pulled back to, what's that level? We had this pullback in consumer staples, but still with the oil prices and everything still up, that really goes back to our transportation. You can see where transportation stocks are up as well. They all need oil, and that means they can charge a higher price as well for that, for any of those staples or anything like that. So we can look around. What's the other one? I think we already looked at XLK. You can see we already looked at that one. What was the other one? Which one I have not looked at? The utilities, that one's XLU. It's not really going anywhere. It has two inside months, so for me, it's really compressing. Something's happening with the XLU. XLV is the healthcare. You can see it's still been driven down. This big red line right here is our 200 day, so it's sitting on the 200 day, really possibly collapse. XLC, it wasn't doing as good either, but it's doing a lot better. So when we go back over to the actual chart, we look at XLC, it's actually just turned green on the year, from year to date percent change. And you can see technology is up 5.59%. XLC is only up 0.94% for the year to date. But when you look at it for the year, it actually recovered the same way the SPY did. But this is where I open. This is where the year formed right here. So that's why it's only up a certain amount. But I would look for trades possibly XLK, XLC, XLB, and XLI. All those different things that people need, and it's going to be needed for the build out of those data centers. But if you haven't already, please like, subscribe. This is going to be the end of this video. I appreciate you guys taking the time to listen to what I had to say. I wish you the best. Stay safe out there, and God bless.